to Sense and Sensibility, the Inflation Guy podcast. I am Mike Ashton, the Inflation Guy, and I'm your host. And today on the podcast, there's so much to talk about now that the election is over, and we have at least some clarity about, the general arrow of things, the general direction of policy, and there's no longer this bifurcation that could happen up until the time when we have the election and know who's going to win. But one arrow that's been very clear for very long is at a point of important inflection, and what happens next is highly dependent on a few things that we can highlight, but depend on actions not yet taken and not yet clear. Since I'm the inflation guy and not the economic growth guy, you can presume that this inflection involves inflation. Plus, that's the name of the episode, the point of inflection. So I guess I don't really know why I'm being cagey. We're going to talk about the inflection that is just about to happen and the possible outcomes. But first, a word from our sponsor. This episode of Sense and Sensibility is sponsored by Simplify ETFs, a fast-growing manager of liquid alternative ETFs. Simplify is bringing Wall Street to Main Street by providing access to institutional strategies perfect for diversifying your equity and bond portfolios, previously only available to big institutions and the ultra-rich. Check out their website at simplify.us. That's simplify.us, and you can find their entire lineup of ETFs at simplify.us/ETFs. Now, in our last episode, we talked about how I talked about, you might have talked about it too, but I can't hear you, so I'm just assuming that I talked about how shrinking the federal workforce is a positive supply shock and how deporting lots of non-producing consumers is a negative demand shock. Both of those are positives in the sense that on balance, they'll take pressure off of prices in the medium term. They take pressure off of inflation. In the long term, there's some cross pressures as fewer low-cost potential workers being out there will cause wages to rise more than they otherwise would will put upward long-term pressure on inflation, while the supply shock is an ongoing effect that's positive for inflation on balance in the medium term and in the long term, because it not only raises the country's productive capacity when you take non-productive government workers and put them to actual productive work, and it increases the long-term growth rate by reducing some of the frictions associated with government. So these two effects that we talked about last week or 2 weeks ago will have bigger effects in some markets than in other markets. For example, deporting millions of illegal immigrants will tend to decrease pressure on rents. And as sort of one common example that we use when we talk about how there has been an upward pressure on rents, and partly because we have millions of new people to put roofs over. And if you get rid of those millions of people, then you reduce that pressure. And these two effects, the supply shock and the demand shock, operate over different time horizons. So while both would affect GDP negatively in the near term, meaning, like near term being middle to end of 2025, the demand adjustment of deportations is a one-time effect, taking away, or at least the medium-term effect is a one-time effect as you take away the consumers. And a one-time effect of higher wages in the long run because you have less labor supply. Whereas the supply shock probably takes longer to play out because you have to first lay off the unproductive government workers, and then they have to find productive labor, but it's more extended. So these two things don't necessarily match up. You've got these two positive effects on inflation and cross currents in the longer term, but they're not synchronized. And so it's a little bit hard to see exactly how that is going to play out. But that's not what I'm here to talk about today. That's not the inflection that I'm talking about. I reiterate those points because I think they're very, very important points going forward over the next year or two, whereas some of the other longer term things, the demographics, deglobalization, things like that, are much longer term. But I do think, and those other things, demographics and deglobalization, we've known about for a long time, whereas, the deportation and the supply shock of downsizing government are both things that we only a couple of weeks ago figured out were going to happen. And so I just want to highlight that those are things that we do need to pay attention to that are going to have a meaningful effect going forward. But again, that's not the inflation inflection that I'm talking about here. Over the last couple of years, I've guided you through an important dynamic involving money velocity, okay? And understanding that dynamic has been absolutely crucial to understanding why inflation was not going to suddenly collapse. Understanding why inflation was not transitory in any meaningful sense. Regardless of how supply chain problems caused greater or lesser distress in individual markets, which they did, the used car market, used car prices skyrocketed because the rental car agencies weren't buying new cars, therefore they weren't getting rid of the old cars, and so supply was restricted. Meanwhile, there was lots of demand because of all the cash being pumped into people's accounts. And there were various other things that were imports and so hard to get a hold of during COVID and right after that. So there were, not to say there were not supply constraints and supply chain problems. There certainly were, and part of the supply chain problems, as I said early on, were caused by the fact that there was this mismatch of demand and supply. That normally, when you go through a recession and supply goes down because you have fewer people working, demand also goes down. And so you don't have this big mismatch. And so you don't necessarily, that's why growth doesn't necessarily cause inflation or disinflation. In COVID, we had this massive gusher of money that was keeping demand elevated while supply was constrained. So yes, there were supply chain problems, but those were a function and a symptom of the demand side mismatch. Okay. But anyway, regardless of the supply chain stuff and how there were different markets that were in better or worse shape, it was plain overall through this whole process that the overall level of prices was going to keep going up at an uncomfortable pace because of the money velocity issue. And the analogy that I've used for quite a while, and I think since late 2022, and so if you've been listening to this podcast for a while, you'll know this, and I apologize for repeating it, but it really is a great analogy, is that the sudden geyser of money that we got through various legislative and executive programs that was accommodated by the Federal Reserve, that geyser of money and the money supply rising way too fast for prices to adjust is what caused velocity to decline. So the Fed and the Treasury dumped massive money balances into bank accounts. And since the total amount of money balances is basically determined by the Fed, meaning that, and this is sort of an aside. So I've got an aside within an aside within an aside, which is terrible grammar. But first, on the topic of money balances and why money balances are determined by the Fed. The Fed gives you $10,000. You spend that $10,000. Has the total amount of money balances gone down? And the answer is no, because when you spent that $10,000, you gave it to the merchant puts it in his account. And so the total amount of $10,000 has merely moved from one bank account to the other bank account, and the amount in bank accounts hasn't changed that much, hasn't changed at all. And so that's important to keep in mind that when the Fed dumped money and when they created that money, that was a decision to cause the money supply to grow dramatically. And so when the money supply grows dramatically by 20% or 25%, whatever it was, if M goes up by 20 or 25% and an economic output doesn't exceed the old highs by 20%, and prices don't adjust by 25% right away, then velocity has to go down because MV equals PQ. So P being prices, Q being real output, M being the money supply. So if the M goes up by 20% and P and Q don't, nominal output doesn't go up by 20%, then velocity has to go down. So mechanically, we knew that initial thing was going to happen. But the analogy that I used was of the car speeding away from a trailer that it's attached to, except that instead of being coupled to the trailer with a normal coupling, it's attached by a spring. And so as the car speeds away, the trailer comes along more slowly because the inertia on the trailer causes the spring to stretch as the car moves away more quickly. And so as long as the car is accelerating, the trailer is accelerating more slowly, the string stretches up to some point. Once the car stops accelerating, then eventually the trailer will catch up. And the spring in this case, so the car speeding away is the money supply, the trailer are prices, and the spring is money velocity. Okay? And so that's what happened. That's how you understand why money velocity completely collapsed and why it was going to eventually, as it eventually came back, prices would be catching up with the rise in money. Okay, so we always knew when money supply went up 20-something% that prices were going to go up 20-something%, greater than or less than, depending on how much growth we got, but it was going to be basically that magnitude. And so all the people who told you we had this 8% inflation and then it was going to go back down to 2 it was just ridiculous. Okay, the important thing to note is that we can watch this spring and we know when the spring has gotten back to its normal shape, approximately. In the first quarter of 2020, okay, March 2020, so right about the time COVID was hitting, M2 velocity was 1.39. In the third quarter of this year, it was 1.39, slightly less than 1.39, but rounding up. Okay, so effectively, volatility has roughly completed its round trip. Now, there are some reasons, and maybe we'll touch on these in future episodes, but there are some reasons that velocity probably ought to continue to be a little bit higher than 1.39. There's some secular reasons that should be going up a little bit higher, but the trailer has caught up to the car. And that part, the very predictable part of the money velocity increasing, that is just about played out. And so up until now, it has been exquisitely easy to forecast that inflation was going to stay stubbornly high. To think that it wasn't going to stay stubbornly high, you had to posit some brand new dynamic in money velocity. Money velocity went down hard because something broke and it was going to stay broke. And so as soon as the money supply stopped growing, then prices would stop growing. And there were people who believed that. And there were people some well-known people who said that money velocity is broken. Didn't make any sense. There were other people who made forecasts that inflation was going to go back down because they didn't think money mattered and they were concerned about the recession and other things like that. And they didn't really care about money. Okay, you could spot all of these people who believed that there was that the money velocity that velocity itself was broken, and the people who thought money didn't matter. You can spot those people by noting that they've been completely wrong on inflation in the last couple of years. They called inflation transitory. They thought inflation would drop placidly back to 2% so the Fed could ease again. In fact, a lot of those people were probably at the Fed. A lot of people in those camps. Figuring out exactly where inflation would go, when it would peak. I was wrong. It peaked again after I thought it had already peaked and said so on this podcast. But there was that the exact path that was more nuanced. It depended on a lot of other things. Figuring out how the stickiness of inflation would manifest, whether as it happened, higher wages that caused supercore to stay high because of the wage price feedback loop that happens in core services X rents, and rents that didn't collapse like some people said they should collapse. Figuring out how that stickiness would manifest in those ways required some thought, but figuring out that inflation would stay sticky was easy. Now we are to the hard part, though. The dynamics of inflation in terms of what will drive it forward, what will drive it going forward, are going to depend less on this volatility rebound. And that's the inflection here. The inflection is in what's driving inflation after this. Up to now, it's been largely velocity. Now it's going to go back to kind of the old stuff. Okay, we're going to have to go back to looking at the growth of the money supply and figuring out how it's going to grow. We have to look at the more systemic changes in velocity and not just this rebound mechanism, but okay, it's at 1.39. Should it go to 1.45 or should it go to 1.35? And various other influences such as industrial policy and demographics, deglobalization, which we've talked about before, which help determine the division of nominal growth, that is PQ, into how much P and how much Q. Okay, so those are all more complex and maybe more interesting problems, inherently harder to go and figure out, and right now subject to the critical juncture of policy. For a while, so we're at this inflection. Okay, things are going to happen differently going forward, or inflation is going to happen for different reasons going forward, and so that's the inflection that we're talking about. Which way is it going to go? Well, for a while, the Fed has kept money growth very low and deserves credit for that. I don't know how much they did it for the right reasons or not, but money growth has been very low as the Fed has shrunk its balance sheet, which continues, and raised interest rates, which doesn't continue anymore. From mid-2022 to the end of last year, 2023, M2 actually declined. And that's something that almost never happens because a growing economy needs more money in order to keep prices from actually falling. Again, going back to our algebra, if Q is going up and M isn't and velocity is stable, then P has to go down. If M isn't rising, then nominal GDP has got to stay about the same, which means that if you have real growth, then you have to have declining prices. So if you want stable prices, then, so that you just accommodate the growth in Q, then you have to M going up over time at roughly the long-term growth rate of Q. If you want 2% price inflation, because stable prices cause other issues, then you have to add 2% to that growth rate. So if you think that the economy's growth potential is, say, 2.5%, and you want 2% inflation, then you want no more than about 4.5% M growth. And that's, of course, on average and as policy. Money supply growth jumps all around over time. We're talking about underlying secular effects and not quarter to quarter or year on year moves, which the Fed has almost no control over anyway. We're talking about kind of as policy. Should the Fed start to become tighter when money growth gets to 5 or when it gets to 7? At what point, or 8? At what point does the Fed start to step on the monetary brakes? Okay, assuming that the Fed cared about money growth and not about economic growth, which in practice they tend to be more guided by economic growth and inflation than they are the actual monetary metrics. But so we are at an inflection where the drivers of inflation are changing, and the main driver is going to be money growth. So now we have two problems. Okay, the first is that for a very long time, the Fed hasn't followed that formula, and money growth has been well above 4.5%. from the end of 1999 to the end of 2019, so for 2 decades, M2 grew at an annual rate of 6.25%. But inflation stayed low because there were some big secular forces, globalization and demographics, which have now switched into reverse. So that discrepancy between the sustainable growth rate for money being around 4.5% and the actual growth rate of 6.25%, it's a discrepancy because prices stayed low, and that showed up in a steady secular decline in money velocity, which again led a lot of people to say there's something permanently broken about velocity. But that velocity decline was made possible by the steady decline in interest rates, which lowered the incentive to hold cash. The first problem is that game has been played out since before COVID, in fact, when we were talking about it. And the balance was getting more difficult. 6.25% growth rate of money was not going to be sustainable going forward. It was going to have to be less. But that's the game we're back into. And the question is, does the Fed realize that we're in that world? Nothing suggests that they do. And if they end up with money growth at 6 or 7%, as was normal before COVID, we will have inflation that stays in the high threes, low fours. So that's the inflection, moving from velocity driving it to money growth being the main thing again. Which way the inflection goes depends largely on whether the Fed restrains money growth to be in the 4 or 5% range, or lets it go to the 6 or 7% range. Unfortunately, over the last 3 months, I said through the end of last year, the end of 2023, money M2 was declining. Well, it's rising now. It's 3.1% over the last 12 months, but it's also accelerating. Over the last 3 months, M2 growth has risen at a 5.2% rate. So that's at the upper end or a little bit above the upper end of what's tolerable going forward. Now, again, that's just a 3-month growth rate. And as I said, we're talking about 4 or 5% being kind of the secular average. That's what we're targeting. So 5% doesn't alarm me. But if we creep up to 7, then it's going to start to become a little bit more of a concern. So we're right on the cusp at that 5.2%. But the Fed is also currently cutting interest rates. And they're at least talking about ending the balance sheet runoff. If money growth is at 5%, they shouldn't be doing that. They should be, because both of those things, ending the balance sheet runoff in particular, is going to tend to cause money growth to accelerate further. My gut tells me that they're going to end up in the old range of money growth, which means much higher inflation than the old range that we had become accustomed to, thanks to secular trends in globalization and demographics. Now, we are in December, and we get into the holidays here, and that means a holiday publishing schedule to some extent, which means this may or may not be my last podcast of the year. I don't do an annual podcast episode or blog very much anymore. I used to do it when I was writing for Bankers Trust or Barclays, and it's a great discipline. It's a great discipline to sit down, and in fact, I recommend this for all investors. A great discipline to sit down and write out your expectations for interest rates, the yield curve, volatility, equities, commodities, energy commodities, gold, the deficit growth, and the dollar and so on. Okay? What do you think is going to happen? It makes you think through the possibilities. But if you do it, and here's the trick, and here's how I think most annual outlook pieces mess up. Don't just make point forecasts. It's very important to consider the range of possibilities. The reason people make point forecasts is they want to be able to look at the end of the year, and out of their 37 predictions, they say, look, we were dead right on 3 of them. And if you make a bunch of point forecasts, you'll be dead right on a couple of them. But we don't really care. It's more important to have the range of possibilities because that informs your investing. Example, if you think 10-year rates are going to go up 25 basis points, but you think it could be as much as 50 basis points in one set of circumstances, but if we have a recession, maybe it's going to be a 200 basis point decline in interest rates, then being short bonds, even though you think interest rates are going to go up, is probably not the best play because the outcomes are so skewed. So you should think about the outliers, and then don't forget to consider what happens to other markets if that scenario plays out. So thinking about the portfolio holistically this way also helps you position. It might be that the same scenario where bonds rally 200 basis points is a scenario where the dollar drops hard and equities rally. I don't know. I'm just making this up. In that case, then maybe being long non-U.S. equities is a better way to be long for that scenario than just being long bonds. Again, I'm not saying that's my call. I'm just sort of giving an example. And you get that through the discipline of sitting down, setting your expectations and your forecast, but also thinking about how each of those forecasts can be wrong and what scenarios affect multiple forecasts at the same time. It goes back to something that I fervently believe about strategy, as it should be practiced, isn't necessarily practiced. And that is that it's less important to get the answers right, such as, say, the forecast that median inflation was going to be trending to the high 30s and low 4s. But that's less important to get that exact number and that part right than it is to get the questions right, which is, the question we asked way back when was, well, why should inflation return placidly back to the old levels? What has to be true if that's the case? Well, it means velocity has to be broken. Why would velocity be broken? And if it is, what should we be doing instead? What is there a new dynamic that's operating, or is this just the same old dynamic with big changes involved? And what does that mean? Okay, so those are the questions, and getting the direction right and the risk and reward trade-offs right is much more important than forecasting that the S&P 500 will be at 6,352 at the end of the year. By the way, in our quarterly inflation outlook, which, by the way, is now available for only $29.99 a quarter or $40 for one issue at inflationguy.blog/shop. In that quarterly, I give point forecasts for inflation, but I also show a one standard deviation range of possible outcomes, and it's not symmetrical, right? So, it is often the case that the long tail might be to the upside. And so even though my point forecast is, 3.8 on median CPI, for example, maybe I think the range is 3.4 to 4.8. Saying that if I'm wrong about the target, I'm much more likely to be way off on the high side, for example. Anyway, I highly recommend the discipline of sitting down and doing an annual examination like that. I'm not going to be doing it. I have started to shy away from doing it publicly because it's hard to get the nuance right. If you get the point forecast wrong, then even if you're completely right about the risk reward, then people think you were wrong. And, I don't really care about being right on the point forecast. The question that I and you as investors should care about is not about whether we were right about the state of the world that actually happened. The question is whether we got the best return possibility for the risk we were willing to take, and whether we budgeted the right amount of risk. And those are really the only two questions. One, how much risk am I willing to take? And then what is the arrangement of my portfolio that gives me the best chance of a good return for that level of risk? No guarantees, okay? So you don't measure by what was your return relative to your risk, right? You want to measure what was your best possibility of return relative to the risk that you were able to take. Anyway, that's hard to put into a column about, this year's forecasts. It's probably easier to do in a podcast because this is more of a conversation, but it would be a really long forecast and probably not something that I'll be doing. I do have a couple of other topics that I do need to cover, but they might have to wait till the new year because people don't listen to podcasts as much at the end of the year. But anyway, I'm happy to have conversations like that with customers, so become a customer. That's more fun anyway because customers talk back and give me feedback, and I love that. Anyway, that's all for today's podcast. Please like it and refer other people. Subscribe if you haven't already. I'd like to get these numbers up a little bit more. You can contact me at inflationguy@enduringinvestments.com and subscribe for free to the blog at inflationguy.blog. Of course, you can go and Subscribe to the quarterly if you like there as well. Follow me on X at inflation_guy, and I've started putting myself on some of the other, Blue Sky and Truth Social and stuff like that. I don't know if I'm going to do anything there, but anyway, you can find me inflation_guy in most places. We're Inflation Guy. Visit Enduring Investments if you need help with treating an inflation problem, and most importantly, defend your money. And if inflation is coming for you, remember, you know a guy.